What's up everyone, it's Vincenzo and welcome back to the channel. Today we're diving deep into the world of mortgages, a topic that can often feel like a confusing maze of interest rates, loan terms, and confusing acronyms. Whether you're a first-time home buyer or a seasoned investor, understanding how different mortgages work is crucial for making a smart financial decision. Before we get started, remember this video is for informational purposes only, and I'm not a financial advisor. Everyone's financial situation is unique, so it's essential to consult with a qualified mortgage professional to get personalized advice. But by the end of this video, you'll have a solid understanding of the various mortgage options available, their pros and cons, and which one might be the best fit for your individual needs. So, let's break it down and demystify the world of mortgages together. First up, let's talk about the gold standard, the most popular kid on the block, the fixed rate mortgage. Now, as the name suggests, with a fixed rate mortgage, your interest rate remains the same throughout the entire life of the loan. This means your monthly mortgage payment, including both principal and interest, will stay consistent. Think of it like this. You're locking in a guaranteed payment for the next 15 or 30 years, which can be a huge advantage, especially in times of economic uncertainty. You'll always know exactly how much you owe each month, which makes budgeting and planning for the future much more manageable. No surprises, no sudden spikes in your payments, just pure predictable stability. This type of mortgage is perfect for those who value predictability and plan on staying in their homes for the long haul. You see, when you lock in that fixed interest rate, you're protected from potential interest rate hikes in the future. Remember those crazy interest rate hikes we saw in 2022. Well, imagine if you had a fixed rate mortgage back then. Peace of mind, right? However, it's important to note that fixed rate mortgages typically come with higher initial interest rates compared to adjustable rate mortgages, which we'll discuss later. But that initial higher rate is the trade-off for the security and predictability that a fixed rate mortgage provides. So to recap, fixed rate mortgages offer stability, predictability, and protection from rising interest rates. They're like the rock-solid foundation of your financial future. Next up, we have adjustable rate mortgages, also known as ARMs. Unlike their fixed rate counterparts, ARMs come with an interest rate that can change over time. Think of it like riding a roller coaster. There will be ups and downs, but hopefully the thrill is worth the ride. These mortgages typically start with a lower introductory interest rate for a fixed period, often 3, 5, or 7 years. After this initial period, the interest rate can adjust periodically, usually based on market conditions and something called an index rate. Now, this means your monthly mortgage payments can either go up or down, depending on the direction of interest rates. If interest rates rise, so will your payments, and vice versa. It's a gamble, but it could pay off. So who are ARMs good for? Well, they're often a good fit for borrowers who plan on selling their homes or refinancing before the initial fixed rate period ends. They're also a good option for those who anticipate their income increasing in the future and are comfortable with a bit of risk. However, it's crucial to be aware of the potential downsides of ARMs. If interest rates increase significantly, your monthly payments could become unaffordable. That's why it's essential to carefully consider your financial situation and risk tolerance before opting for an ARM. To sum it up, adjustable rate mortgages can offer lower initial payments and potential savings but come with the risk of fluctuating interest rates. They're like a high-risk, high-reward investment. Exciting, but requires careful consideration. Chapter 3. Interest-only mortgages. Short-term strategy, long-term considerations. Now let's talk about a different breed of mortgage, the interest-only mortgage. As the name implies, with this type of loan, you'll only be making interest payments for a specific period, typically the first few years. This means your monthly payments will be lower compared to a traditional mortgage. But here's the catch. You won't be paying down any of the principal balance during that initial period. Now think of it like renting your money. You're essentially just covering the interest on the loan, not actually owning more of your home each month. This can be a double-edged sword. On the one hand, lower initial payments can free up cash flow for other financial goals, such as investments or paying down higher interest debt. This can be particularly appealing to real estate investors or those with fluctuating incomes. However, it's crucial to remember that the principal balance remains untouched during the interest-only period. Once this period ends, your monthly payments will likely increase significantly as you start paying down the principal. This can be a shock to your system if you're not financially prepared. Interest-only mortgages can be a useful tool for certain situations, but they're not for the faint of heart. It's essential to have a solid financial plan and a clear understanding of the long-term implications before diving into this type of loan. Chapter 4. FHA loans. Opening doors for first-time home buyers. Alright, let's shift gears and talk about a fantastic option for first-time home buyers, FHA loans. These loans are insured by the Federal Housing Administration, which makes them less risky for lenders and, as a result, more accessible to borrowers. One of the biggest advantages of FHA loans is the lower down payment requirement. While conventional loans typically require a down payment of 20%, FHA loans allow for down payments as low as 3.5%. This can be a game changer for first-time buyers who might not have a huge chunk of cash saved up. Another perk of FHA loans is that they're more lenient on credit scores and debt to income ratios. So, if you have a less than perfect credit history or are carrying a bit of debt, an FHA loan could be your ticket to home ownership. However, it's important to note that FHA loans come with something called mortgage insurance premiums, or MIP. These premiums are added to your monthly mortgage payments and protect the lender in case of default. While MIP can add to the overall cost of the loan, it's a small price to pay for the opportunity to become a homeowner. So if you're a first-time buyer looking for a more accessible path to home ownership, an FHA loan could be the perfect fit. Chapter 5. VA loans. Honoring our veterans with exceptional home loan benefits. Finally, let's talk about a loan program specifically designed to help our nation's heroes, VA loans. Guaranteed by the Department of Veterans Affairs, these loans offer incredible benefits to eligible veterans, active duty military personnel, and surviving spouses. One of the most significant advantages of VA loans is that they don't require a down payment. That's right, you can potentially purchase a home with zero money down, which is a testament to the sacrifices made by our veterans. On top of that, VA loans don't require private mortgage insurance or PMI, which can save borrowers thousands of dollars over the life of the loan. And as if that wasn't enough, VA loans also come with competitive interest rates and flexible credit guidelines. It's important to note that while VA loans don't require a down payment, there's a one-time funding fee that can be paid upfront or rolled into the loan. However, even with the funding fee, VA loans offer unparalleled benefits to those who have served our country. So if you're a veteran or active duty military personnel, a VA loan could be the most affordable and accessible way to achieve your homeownership dreams. It's a small token of appreciation for your service and sacrifice. That's it for today's deep dive into the world of mortgages. We've covered a lot of ground, from the stability of fixed-rate mortgages to the unique advantages of FHA and VA loans. Remember, understanding the different options available is crucial for making a smart and informed decision for your financial future. If you found this video helpful, please give it a big thumbs up and subscribe to the channel for more personal finance tips and tricks. And don't forget to hit that notification bell so you don't miss out on any future content. Most importantly, remember to consult with a qualified mortgage broker to discuss your specific financial situation and determine which type of mortgage is right for you. Thanks for watching, and I'll see you in the next video.